Well, folks, I want to thank everyone for joining us in this latest session of the conference. And the topic is Causes and Measurement of Inequality. My name is Peter Coy. I'm an opinion writer at the New York Times. We have 3 speakers. I won't give you extensive bios because you have that information. Just to say, it's Michelle Holder, John Jay College of Criminal Justice, Tom Masterson of the Levy Institute, and Ajit Zacharias of the Levy Institute. The plan is for each to speak for 20 minutes, which would take us an hour, and then to have half an hour at the end for them to speak to each other. And I'll ask some questions and we will invite Q&A from all of you. Please submit your questions via the Q&A function, and I will pick among the questions. I'm going to ask the speakers to stick to 20 minutes so that we can give everybody a full opportunity to speak. And with that, I'm going to take myself off camera and mute myself, and Michelle is going to go first.
Thank you so much, Peter. And thank you to my co-panelists, Ajit and Tom. I'll call them by their first names because I've known these guys for a long time. So no doctor here. Yes, it's a pleasure for me to be here. Happy to be able to participate in this important event. And it's wonderful that this is the 31st year of the Levy Economics Institute annual conference. So let me go ahead and share my screen. Okay. So I'm going to be talking about inequality in the labor market, particularly in the US labor market today, and how it can be evidenced, and to give you all also a concrete example of it based on research that I conducted. And I'm sorry if you are hearing noise in the background. I am by my window and I live in Upper Manhattan, in Harlem to be exact. So there may be some fire trucks and things going by. So how is inequality evidenced in the US labor market? Inequality in the American labor market can be sort of demonstrated in a few different ways, but the most, I'd say, recognizable way would be differential pay, right? So Einer and Kane in 1977 noted in a paper that labor market discrimination has been traditionally defined as, quote, different pay for workers of the same ability. Now, unemployment rate differentials are another way by which we can discern there are inequities happening in the labor market, unemployment rate differentials by demographic group. So, for example, in the US, there used to be this rule of thumb among economists that, particularly labor economists, that the Black unemployment rate was typically twice the white unemployment rate. So that inequity is pretty clear, I would think, pretty straightforward. Another way in which inequality can be discerned in the labor market would be occupational crowding, looking at the occupational distribution by demographic group. And are there some demographic groups that are crowded into certain occupations, primarily low-wage occupations? So these are a couple of ways in which I and others look at inequities in the labor market. I'm going to talk a little bit about the first strategy, which is really differential pay. And I'm going to start with the gender wage gap, which, you know, we're all familiar with. We've all heard of. We all probably have opinions about. And let me talk about the formulation. So the formulation of the gender wage gap in terms of how you calculate it is pretty straightforward. It's a comparison of the average or median full-time wages of all working men. And again, the case study that I'm looking at is the US, all full-time working men in the US, and compare that to the average or median full-time wage of all working women in the US. Now, the current estimate And this is according to the Bureau of Labor Statistics. There are other estimates that have been advanced, including by the Institute for Women's Policy Research in Washington, D.C. They are perhaps an organization that is pretty well referenced in terms of their calculations of the gender wage gap. But this particular calculation is coming straight from the federal government, the Bureau of Labor Statistics. So as of 2023 annual data, men working full-time earned a median of $62,500 annually. And women working full-time earned $52,000 annually. And again, this is at the median. So based on that, just looking at all full-time working men and all full-time working women in this country, in the US, women earn 84 cents on the dollar that men earn, or 84% of what men earn. Now, there are some mainstream explanations that have been advanced for why there is this existing gender wage gap. Most notably would be that, well, it's likely that women possess lower human capital endowments than men. And this explains this gender wage gap. So, the human capital explanation is usually the one advanced when we're talking about wage differentials, that there must be some differences in educational attainment or training or work experience, some human capital attribute. Another explanation that would fall in the mainstream camp would be that this is a choice of women. Women choose to work in lower wage occupations, which is then reflected in the gender wage gap. And perhaps one of the reasons that women choose lower wage occupations is because they provide fewer career demands for women who may also be the primary caregivers in their families. Another explanation, which relates to the caregiving issue, would be that because women, more so than men, tend to be the primary caregivers in their families, which is the case in the US and most other countries in the world, that sometimes means that women stop out of work. They need to take time off from work, longer intervals, shorter intervals. But whatever the intervals are and the frequency, any sort of stopping out of work has a dampening effect on wages for that position going forward. And those stop outs also have an effect on the years of work experience that worker has, which employers value and compensate, right? So these are some of the typical but not all inclusive explanations that have been advanced for why there is this existing gender wage gap, at least on the mainstream side. And so now I want to talk a little bit about the racial wage gap, because there is also, in addition to the gender wage gap in the US, a racial wage gap. And when I talk about racial wage gap, I'm talking specifically about Black workers, what Black American workers in the US encounter in the labor market in terms of earnings disparities. The formulation of the racial wage gap is pretty much the same as the formulation of the gender wage gap in terms of calculating it. You simply take all full-time working white, full-time white workers in America, their median or average annual wages, and compare that to the same for Black workers, all full-time Black workers, their average or median annual full-time earnings, and you derive an estimate that would be codified as the racial wage gap. The current estimate, again, according to Bureau of Labor Statistics data, is that white workers, men and women, earn a median of $59,000 annually. And Black workers, men and women, earn a median of 48,000 US dollars annually. And so that boils down to Black workers earning on average 81 cents for every dollar that white workers earn, or 81%. Now, I'm going to take this analysis a little step further because this relates to the research, my research that I'm going to link into this discussion in a little bit, where I compare white male workers and Black female workers, and the wage differentials thereof. And so also according to BLS 2023 annual data, white men working full-time earned a median of 63,700 US dollars annually, and Black women earned 46,000 US dollars annually as of 2023. So the earnings gap for Black women compared directly to white men, based on race, Black women's race and gender, boils down to Black women earning 73 cents on the dollar that white male workers earn. And so you can see that there is obviously an effect of both the racial and the gender wage gap. It's not an additive necessarily effect, but obviously 73 cents on the dollar is lower than the racial wage gap of 81 cents on the dollar, and lower than the gender wage gap of 84 cents on the dollar. So there's, some multiplicative, perhaps, effect going on. And so the mainstream explanations that have been advanced for the racial wage gap are pretty similar to the explanations that have been advanced for the gender wage gap. Human capital deficiencies. Now, there is some truth, there is some evidence that does support part of that human capital explanation in the following way. In the US, at the level of college completion, there is a large gap between white adults 25 years of age and older and Black adults 25 years of age and older. So about 38% of non-Hispanic, non-Latinx white adults in this country have a college degree or higher, compared to 28% of Black American adults. So it's a 10 percentage point gap in college completion. That explains some of the racial wage gap, but it doesn't explain all of it. And there's been other empirical research which controls for these human capital and other variables that can contribute to differential wages by race, that have these unexplained residuals, which are usually and have been attributed to employer discrimination. That assumption has been largely supported by what's called audit studies, where testers are sent out from different demographic groups to see the employer response in terms of hiring, and wage offers. And there have been plenty of such studies. Some of the most notable: Pager and Western, 2005, Bertrand and Mulanathan in 2004. Most recently, Killian et al. In 2017, which was a meta-analysis looking at 25 audit studies over the course of the past couple of decades, and pretty much showed conclusively that what is happening is still happening is that employers, whether they be white or not, but employers in this country still show a preference for white workers over Black workers. And so the chart there are a couple of charts, it's a little bit busy here, but what I really am trying to show with this chart is what I have said regarding unemployment rate differentials. The first chart to your very left shows the average annual unemployment rate by race in the US from 1972 through 2022. The white unemployment rate is the blue line, the Black unemployment rate is the orangish line. And you see you know, they have valleys and peaks, you know, during the same time intervals, but they're quite far apart, except when you get into the last few years, actually, where the gap, what's called the Black-white unemployment rate gap, is actually narrowing. The figure, the chart right beside that chart, is showing the relationship between educational attainment and unemployment in the US. And I'll just tell you what it's depicting, because it's a little squashed. It basically is showing a really strong inverse relationship between educational attainment and unemployment in this country, meaning the higher your educational attainment, the lower your unemployment rate is likely to be in terms of the demographic group you belong in. And so, again, this, you know, supports what I spoke to earlier, which is there is this big gap in college completion between Black and white adults in the US, which does help explain some of the racial wage gap, but doesn't explain all of it. And the third chart is essentially showing, it's depicting this college, this educational attainment gap at the level of college completion between Black adults and white adults. So let me just talk a little bit about occupational crowding and labor market disparities. And
Michelle, 5 minutes.
Okay, all right. So I may have to skip over a few things. I may have to skip over some of the methodology. So researchers looking at gender-based occupational crowding typically argue that women are crowded into low-wage occupations and crowded out of high-wage occupations. And therefore, any comparison of full-time wages between women and men, therefore, will be affected by women's overrepresentation in low-wage occupations. Patrick Mason in 1999 indicated, in terms of the racial wage gap, that racial job segregation is one of the mechanisms through which racial wage discrimination is maintained in the presence of labor markets, competitive labor markets. So occupational crowding research, therefore, attempts to explain persistent labor market disparities as evidenced by racial and/or gender wage differentials accommodated by race and or gender-based occupational segregation. So the labor market is still competitive, and people are choosing their jobs, but because of their occupational distribution, what you have are wage inequities. And so in terms of, I did an analysis where I looked at the gender and racial wage gap that Black women encounter in the American labor market. And I termed this the double gap in earnings, or the double gap in wages. Why look at the wage gap Black women face? Well, it has implications for their communities, for their families. It also has implications for their wealth building. It has implications for their retirement. Teresa Ghilarducci is going to be speaking later, and she can attest to this fact that if you looked at retirement savings by demographic group in this country, Black women would have among the lowest levels of retirement savings. So there are myriad reasons for me to look at this issue. In terms of what the double gap means, again, it's just codifying this racial and gender wage gap. It doesn't mean that you add the racial and gender wage gaps and you come up with the double gap. It's not an additive relationship. It's just codifying the fact that Black women encounter more than one form of wage disparity in the American workforce. Because I don't have that much time, I'm going to quickly just go through my findings. What I found at the aggregate level is that Black women, what I term involuntarily forfeit $50 billion in terms of wages and salaries to the private for-profit sector in the US due to the racial and gender wage gaps they encounter, the double gap. What this means at the individual level is, on average, Black working women in this country encounters or is remunerated $20,000 less per year. Of course, this varies whether it's a low-wage occupation or high-wage occupation, but on average, about $20,000, which over a lifetime, it could total nearly $1 million over a 40 year working career. I won't talk about my data sets. I'll pretty much skip over my methodologies, but what I do want to mention in this research is that Tom Masterson, who is on this panel, assisted me in this research. So Tom, what essentially I asked Tom to do was to conduct his own independent methodology to look at this double gap issue. So I had two methodologies, and I enlisted Tom independently to use a different methodology to get at the same issue, which is what do Black women encounter in terms of earnings penalties in the American labor market. And we pretty much landed upon the same magnitudes. So I just wanted to give, Tom a shout out that he was a necessary part of this research that I did. So this is what I really want to get to before I need to wrap up. And which is what may be causing the double gap, or as this session is about, causing inequality. Well, in this research, in my double gap research, what is not causing it would be human capital differences. Because in the methodologies that I employed and that Tom employed, we controlled for human capital, what might contribute to differentials as attributed to human capital, to work experience, to training, to regional cost differences. We controlled for all of that. And even with that, there was still this residual that could not be explained away by anything else. Now, what may be contributing to this double gap? What it really boils down to is employer behaviors. Employer behaviors that produce disparate outcomes by race and gender. Now, mind you, these behaviors may not be overt or even cognizant on the part of employers. And again, not all employers in this country are white, right? But there are employer behaviors which may be contributing to this double gap. And I'll just quickly go through a couple, one of which would be steering or channeling. And so in the audit study that I mentioned by Pager and Western from 2008, what they found in terms of sending out testers, Black, Latinx, and white, was that the Black and Latinx, these were male applicants, in responding to jobs, they were steered down into lower paid sub-occupations. So they would, so that's telling me, and Peter, how much time do I have?
You're a bit over now, so try to wrap up quickly. Thank you.
Okay. So yeah, the issue could be the steering of Black women into lower paid sub-occupations within the same occupation. The issue could also be what is called pre-market structural discrimination in terms of even if a Black woman and a white man have the same or similar position, what kind of college did she go to? Was she able to access an elite college as compared to her white male counterpart? There's also the practice on the part of employers of requesting previous salary histories from job applicants when they apply for a job. That has been definitively shown to disadvantage women and minorities in the American labor market. Networks may also be contributing. Holzer has argued that Black workers are more likely to rely on formal routes to employment as opposed to white workers who have informal networks and perhaps stronger networks. So since I'm over, I will leave it there. Thank you all so much. And I look forward to hearing my colleagues talk and responding to questions. Thank you.
Thank you very much, Michelle. Very enlightening. And I'm wondering, maybe Tom should go next because he's worked with Michelle. Tom, does that make sense? You go next?
Thank you. And thank you for the shout out, Michelle. And okay, so let me share my screen. What I'm going to be doing is, what I'll be doing is talking about the evolution of time and income poverty in the US. This is a project that myself, Ajit, and also Fernando Rios Avila and Ashima Sinha have been working on this year. It's a long time coming. We're finally doing the limb tip for the US. So what I'm going to do is talk quickly about the motivation for this research program as a whole, and then a little bit about the data that we're using for this part of it, and then how we develop the limb tip measure, the time and income poverty measure. Some of you have heard this multiple times, others have never heard it, so I'll get into it a bit, and I'm happy to answer questions, of course. And then talk a little bit about the results that we find, the kind of aggregate top of the headline results that we get. There's a lot, so I'm just going to give a summary of what we find, and then wrap up. So first, I want to talk about what we find. So where we're headed is, when we take time poverty into account, we find that poverty is, more widespread in the U.S. than official estimates suggest. So, and time poverty rates, when you look at who is time poor and who isn't, are higher for women than for men, and for the employed than for the non-employed. And finally, the pandemic has created big shifts in time use, and as well as public policy, although the latter have largely ended, that caused reductions in both time and income poverty. The shifts in time use aren't so much in household production work time, although there was kind of the stylized facts about the lockdowns and everything were more household work than before. That we don't really see that in the data. What we do see is over the last couple of decades, an increase in the amount of time that U.S. people spend sleeping. It's an additional 3 hours, and commuting time, which decreased since the pandemic. Those are the big drivers of changes. Those are the big changes in time use. So why are we talking about time when we're talking about poverty? So feminist economics has long advocated for the recognition, reduction, and redistribution of unpaid work that's done in households, because in every society that we've looked at, and all the others as well, most of the household work, the unpaid care work, the unpaid work done in households is done by women. And we'll see in a bit that the US is no different. So we've been working on that in this research program, the Levy Institute Measure of Time and Income Poverty, for the last 12 years or so, 12, 13 years, that addresses these three goals. The recognition part is the measure itself, the Levy Institute Measure of Time and Income or Consumption Poverty. And we'll see how that addresses the recognition part when I talk about the methodology. But we've done this for a number of about 10 different countries at this point, and finally we're doing it for the US this year. Then in terms of reduction, we've looked at the impact of investment in social infrastructure on time use and on time and income poverty in a number of different countries, including Ghana, Tanzania, Jordan, Turkey, and Mexico. And then finally, redistribution. We've looked at different schemes of redistributing household production time and their potential impacts. So let's go. So why time and income? Poverty lines are supposed to reflect a certain standard of living, right? That's what they're supposed to measure, a minimum quantity of goods and services necessary for survival. But along with that, you need a certain minimum amount of time to kind of convert the commodities that you buy into goods and services that are consumed by the household, and do a bunch of other stuff to maintain the household that has to be done. And so the U.S. thresholds from the beginning have always assumed implicitly that there's somebody who's working full-time in the household. However, right, that isn't necessarily the case, right? And we need to explicitly account for the time that people have available to spend on the required household production hours, right? And if people don't have the time, they actually need more than the poverty threshold in order to achieve the standard of living that the threshold is supposed to represent. So what we're saying basically is that ignoring time deficits, so when households don't have the time left over after their income generating activities, if you ignore those time deficits, then you have an inconsistent measure of poverty. And if you're saying that, if you're thinking to yourself, are you saying that all poverty thresholds are inconsistent internally? I am, but not to fear, because we're here with a measure that'll address this. So just briefly to talk about the data for this study, what we're using is basically two main data sets: the American Social and Economic Supplement, the ASEC, and that is the survey used to produce estimates of official poverty estimates for the U.S. every year, and the American Time Use Survey, which has information on time used by individuals and households. We also use the Merged Outgoing Rotations Group from the Labor Force Survey to get wages for replacement costs, which we'll talk about in a bit. And it's from 2005 to 2022. That's the latest year we have both income and time use information for. So I want to briefly talk about the official and the supplemental poverty measure. The official poverty measure goes back to the early 60s, and it has some problems. There's a new supplemental poverty measure that we're using as the basis for this study, and it addresses some of the important problems with the official poverty measure, including the fact that the official poverty measure, the resource measure, is just household cash income, so it's not after tax. It doesn't include things like medical expenses and things like that. So the supplemental poverty measure starts with cash income, but it includes non-cash benefits, and it subtracts taxes or adds tax credits, and it subtracts work expenses, medical expenses, and child support paid to other households. So that's an important improvement, and so we're using that as the basis for our study. So the Levy Institute measure of time and income poverty, then, we start with calculating an individual's time balance, and that is basically 168, which is the number of hours in a week, minus a number of amounts of time. So one is the minimum time required for personal maintenance and non-substitutable household activities. That's M. And then this alpha IJRJ, which is one of the important aspects of our measure, is the share of individual I in household, the required household production. So RJ is the minimum household production required to subsist at the poverty level, and alpha IJ is the share of each individual in that required household production. Then D is just an indicator for employment status, and then L is the time spent on income generating activities. In the US, that's mostly wage employment, and then commuting time. So what you get with this little equation here is an amount of time available after personal time, required household production, and income generating activities. And if it's negative, we say you have a time deficit. So what do we do then? Well, we take the individual time deficits and we add them up. We don't add up the surpluses for the simple reason that we don't observe people with surpluses doing more, right, to help people with deficits. So we add up the time deficits for the household, and then we apply replacement cost, that's the P there, which we get from the morgue, and that is the basically the mean wages for domestic workers. And we add that product to the official threshold. So what we get is a time-adjusted poverty threshold that is either the same as the official threshold or greater than the official threshold. So by construction, we're going to find more poverty. So to get to this point, we need to calculate four things. First, the minimum required time for personal maintenance. And so we look at the average weekly hours for persons 18 to 64 years, the time spent on personal care, which is mostly sleep, and then the time for minimum leisure and non-substitutable activities. And these are assumptions that we make. And so these are just numbers for 2005 and 2022, the endpoints of our study. And the difference here is in personal care. There's an additional 3 hours in 2022, and that is additional hours of sleep. I mentioned that earlier. That's the main difference between 2005 and 2022. Half of that increase is between 2020 and 2021. Okay, so that's the pandemic impact. So the pandemic put us to sleep, apparently. Alpha IJ is the share of total hours of household production. And I've got it broken down here, again, for the endpoints of the study, 2005 and 2022 by male and female. These are box plots which show the distribution of the share of household production time that men and women do. And you can see that women do more. They have a greater share of household production. Notably, like I said, this is unequal, right? Unequally distributed in every country that we've looked at. The US is among the least unequal, and it's actually improved visibly since between 2005 and 2022. So, for what that's worth. RJ is the poverty level household production requirements. So we figure out how much time a household at the poverty threshold needs to reproduce itself. So how much time do they need to spend on cooking, cleaning, shopping, etc. So we estimate a nonlinear model for households based on a group that are near the official poverty line, so between 75 and 150% of the SPM, the supplemental poverty measure threshold, and at least one non-employed adult present. So basically, what we're doing is we're taking the subset of households that look like the implicit assumption in the poverty threshold, right? So that there is a person that's available full time to do the household production work, and we generate an estimate based on this nonlinear model, based on the number of adults, the number of children, and the number of elders. And that looks like this. So this is just for 2014. Why not? And you can see that, and this is only for adults, for households, SPM units between 1 and 3 adults and 0 and 3 children. We left out SPM units with more adults or more children, just for simplicity of the thing. And you notice that what we're seeing is more adults, more children, more work. Right. So that's.
Hey, Tom, can you move that chart so we can see the bottom of it? It's not showing up on the screen.
It's move it so you can see the bottom.
I mean, it looks like the bottom line I can see is the number of adults and number of children is cut off, and I don't see what the vertical axis is.
Oh, I'm sorry. The vertical axis is weekly hours of household production work. So I don't see that. I don't see anything else either. So I guess it's just a bad chart, but that's what the vertical axis is. So these are the weekly hours. These are the threshold hours of required household production work for households based on the number of adults and number of children. Okay.
Thanks.
Then finally, commuting time. And we generate this based on the time use data as well. And it's the average hours for individuals who are working full-time and part-time separately. We get separate averages, and by geographic division. So these are the 10 census divisions, or 11 census divisions. Anyway.
Tom, you got 5 minutes.
Yeah, okay.
Thanks.
I'm almost to results. Okay, so full-time workers tend to commute longer hours. These are minutes per day. The big change in this data is reduction in commuting time for full-time workers, especially in New England and Middle Atlantic states. There's a significant reduction for those workers between 2020 and 2021. And the reductions, something like 2 hours per week in the New England, have not been reversed by 2023, which are the latest numbers we have for those. Okay, so what we get then is a two-dimensional poverty measure. Households are at the household level if the household income is less than the poverty threshold adjusted by the time deficit. The household's poor, and it's time poor if any of the members have a time deficit. Individuals are income poor if the household is time poor, or the SPM unit in this case, and they're time poor if they have a time deficit. These are time poverty rates for employed individuals by sex. I should say that almost all of the individuals that are time poor are employed. The time poverty rates for employed men, men that are not employed, for example, in 2022 is less than 5%. But for the employed, it's 24%. So, there's a significant difference between men and women. Women have a higher rate of time poverty in every year. We can ask then, is there a relationship between the hours of work that they do and the amount rates of time poverty? And you can see here that at every level of weekly hours of income generating work, women have a higher rate of time poverty. Right? We can see different changes over the Great Recession, right? There's a reduction in time poverty rates between 2007 and 2009. We don't really see that for women anyway, between 2019 and 2022, although for men, time poverty rates are slightly higher, especially for those working more than full time. Just to kind of put that in context, the required hours of household production, right? So that's the household level times the share, right? For men and women in 2005 and 2022, you can see that women have a greater share of household production time at every level of income generating time spent, with a kind of a narrowing of the gap once you get to full-time work, but still higher. Right? And for both, there's a slight reduction, well, significant reductions in required hours between 2005 and 2022. Let's talk about the time and income poverty status. So we have this two-dimensional measure. What we see for what we're seeing here is the blue and the orange areas represent income poverty. So those are the individuals, employed individuals that are below, in households that are below the SPM threshold adjusted by time. The blue is those who are also time poor. And the gray is individuals who are not income poor, but are time poor. And so you can see that there's a reduction in poverty and time poverty that's coincident with the Great Recession. Although time poverty rates were increasing sharply just before the Great Recession, which is an interesting phenomenon. You can see that there's a drop-off in income poverty at 2020, between 2020 and 2021, and this is mostly due to the pandemic income support measures, stimulus payments, et cetera, child tax credits that were instituted during the pandemic. So that's individuals. I want to look quickly at SPM units or families, which is as good a shorthand as any. The employment here refers to an employed SPM unit is any SPM unit with an employed adult. The SPM units that are not employed don't have any employed adults in them. So as you can imagine, income poverty is higher for those households without any employed adults. But you can see that there is a sharp reduction of the SPM and our time-adjusted poverty post-pandemic, right? And this is the child tax credit and the stimulus payment, I think will appear in the household income as well. And then for employed households, the levels are lower, of course, but you still see reductions as a result of the stimulus payments and child tax credits. Finally, the three-way distribution of households. You can see that time poverty, right, of employed SPM units was climbing quite high, quite quickly prior to the Great Recession, but has kind of stabilized overall. And that the impact of time and income poverty is pretty significant. It's, you know, for the most part, it's at least half of the poor, right? To kind of wrap up, since I'm already over time, time poverty is widespread, right? It affects, you know, at least a quarter of the employed adults in the U.S. It's concentrated among the employed, and it's substantially higher for women than for men. Income poverty is, as measured, understates the scale of poverty in the U.S. And the COVID-19 pandemic, you know, the shift to more working from home has reduced time poverty by reduced commuting times and presumably also more sleep. And the pandemic responses, especially the child tax credit, have drastically reduced income poverty, although, as I mentioned, those are now, at least for now, no longer in effect. So
okay, well, Tom, thank you. Thank you very much for the presentation. We'll move right to Ajit, and then after that, we will do questions. Ajit, your turn.
Let me share my screen with you. Thank you very much. So I'm going to present some joint work that I did with Catherine Moose of University of Massachusetts Amherst and Fernando Rio-Sevilla of the Levy Institute. And this research was supported by the Groundwork Collaborative, for which we are very grateful. Okay, so the question that I'm trying to look at is the recent trends in economic well-being in the United States. So we focus on the last two crises on the impact of that on household economic well-being. So the impacts that we're looking at here, they reflect the net effect of the crisis or the shock on income or wealth of the households, as well as the policy response, right? So it's the net impact of both. Now, policy responses include the working of automatic stabilizers, for example, unemployment compensation, which kicks in, it's counter-cyclical, and also discretionary fiscal policy. For example, the economic impact payments following the COVID-19 shock, and can also be monetary policy measures. For example, the facilities to backstop financial markets. So the impacts that we're looking at are the net impacts. Now, in terms of the motivation of the approach that we followed here, is that most of the assessments in the literature on economic well-being, they look at fractiles of distribution. For example, the top 1% versus the bottom 50%. What we're doing here is to adopt a class perspective. And what that does is like really puts the focus on distribution of people over the fractiles, rather than looking at the distribution of, say, income over people. You look at really the underlying forces, and which in a capitalist economy, you're talking about the hierarchical structures of property relations and the social division of labor. So how those mechanisms distribute people over the portions of the income distribution. The other aspect of most studies, which again is the reason why we want to have our own take on this, is that they usually use as a metric of household economic well-being pre-tax income, or at best, some post-tax, post-transfer measure of economic well-being. An example of that is the SPM measure that Tom just talked about. Now, the Levy Institute measure of economic well-being, LEMU as we abbreviate it, is a much more comprehensive measure of economic well-being. So I'm basically going to start talking about the LEMU, what it is and how it's calculated. And then I'm going to present the class schema that's used in the paper. And then I will do a comparison of two periods. The first will be the period of the Great Recession. That's the benchmark years 2007 and 2010, what happened. And we'll compare that to the initial impact of COVID-19, which is 2019 and 2020. Now, in terms of the LEMU, let me start with an explanation about what's the kind of conceptual underpinning of that. Basically, what we are trying to look at is to look at economic well-being as the command or access that a household has over the products produced in an economy. So that's what you see on the left-hand side, that block with the label products. Now, most of the products in the economies that we live in, the capitalist economy, take the form of commodities, things that are bought and sold for money. So then on the right-hand side, you can see boxes with arrows leading up to commodity, saying what? Well, those are the institutions through which your access over commodities are exercised. And that comes from income from wealth and all of the kinds of cash income, primarily income from work, wage and salary income. Then, of course, we have government non-cash transfers. So again, the US context, we're basically talking about Medicaid, Medicare, things like that. And then we also have non-cash labor income. Again, in the US context, we're talking about employer-provided health insurance, right? So then, of course, taxes kind of subtract from that income, and payroll taxes kind of subtract from the command that you can have, the purchasing power that you have over commodities. So that's why they appear with a negative sign, while the other components appear with a positive sign. But then the products of our economy, which are crucial for sustaining living standards, are not all commodities. That's what I describe by this rather clumsy term, non-commodities. Right? So those can be broken down into two. One of which is public provisioning, which you can think of stuff that the state buys on behalf of the households. This will include things like public education, public health, public safety, etc. And then there is also another crucial part, which is the work done within the households that Tom was talking about earlier, household production, or what is described here as self-provisioning. This is taking care of children, maintaining a clean living quarters, etc. So the LEMU is kind of taking into account the command of households over products and exercised through the main institutions of a modern capitalist economy, markets, the state, and the household. Now, in the actual measurement itself, we start with the gross money income, which is the pre-tax money income. It's again on the left-hand side, the top box tells you that. And then we take out government cash transfers and property income. We take them out because we add them later. So that's what the next arrow is pointing you to, where we go once we do that subtraction from gross money income. We get something called base income, what we describe as base income. Primarily, this is all made up of labor income, 90% of it. Now, to which we add our own measure of income from wealth. This is why we are throwing out property income as it's usually measured. As it's usually measured means it's just the sum of dividends, interest, and rent, the actual cash flow that people receive from the ownership of assets. Instead of that, what we put in is, first of all, for homes, honor equivalent, which is the imputed rent. And then for non-home wealth, we annuitize it, meaning that we calculate an annuity for non-home assets. Now that calculation is done based on the portfolio that each household has. We take into account about 5 different assets. And we have rates of return that are differentiated by assets. And that's what gives us that imputed annuity from non-home assets, from which we take out the annuitized value of debt. Again, we have two kinds of debt here, mortgage debt and credit card debt and automobile debt and things like that, revolving debt. So that's like one component of that. Then the other part consists of what we call as net government expenditures. This is basically the difference between what the government spends for the households and what the household tax payments are, right? So that's what's shown on the left-hand side box. So we have transfers, which a lot of other income measures do have, but we also have public consumption. This is the publicly provided, commodity products that we were talking about in the previous slide. And then we take out of that taxes to get the net government expenditure. Adding to that, we put in the value of household production, and the sum of all that gives us the GDP. Now, in terms of sources and methods, our basic representative sample is the ASEC, which Tom just talked about in his presentation. And then we carry out imputations for the time spent on household production for each individual in the ASEC, while doing a statistical match between the ASEC and the American tax. Similarly, imputations for the household wealth portfolios for each household in the ASEC is carried out by statistically matching the ASEC with the Survey of Consumer Finances, which is the premier source for data on household wealth. Then the other major source of data mentioned, I just put them down there, but there are a lot and we don't have the time to go into that. Okay, so now let me turn quickly to the class schema. So the starting point is in the identification of what we call as capitalist households. Now they are identified using wealth thresholds. Right? So there are two thresholds that we are using. One is like the amount of real estate and unincorporated business wealth that you may have. So the threshold here is like nearly about $3.5 million. This is all in 2022 dollars, right? Or you have a net worth of $8.5 million. Now, what's the logic behind these thresholds? The basic criteria that we use is that does it give you a cash income, a pre-tax income, that'll put you like way at the top of the income distribution. In other words, freeing you of the compulsion to engage in employment. So just to give you an example, if you use the 8.5 million threshold, using the standard like 4% rate of return, the annual income will be roughly around 340K, which would put you in the well within the richest 5% of households in the US. Then, as for non-capitalist households that are not in that group, the high wealth group, they're categorized using occupational class and also employability. So there are three cases here. First is where the householder or the reference person is an earner, in which case we assign the household the occupational class of the householder's occupation class. We use that, we use the Census Bureau's occupational titles, nothing else, to determine this class location. The other instance is where the household is not an earner, right? The reference person is not an earner. But if the household has other earners, then we pick the person with the highest labor income to assign the occupational class. Then also there is what old classical economists used to call the reserve army or the potential worker households. These are households with no earners and householders of working age who gave the reason for not working as could not find work or taking care of home or family. So that's class schema. Now, just to give you an idea of the percentage distribution of households over this class locations, that's what's shown here for 2007 and 2020. As we can see, this is like a 9-class schema. So we have all the way on the right-hand side, the small bars, the smallest actually of the lot, which shows 2% in both years, is the potential worker household. Following that, we have the self-employed group, which this is the next one from all the way to the right. And then we have the largest group, which is the worker, what we call the worker households. Then moving further to the left, you can see the skilled blue-collar workers, then the skilled white-collar workers. We have the professionals after that, and then the supervisors, and then the managerial class, and then finally, all the way to the left, the capitalist class, the 3%. So the class structure, as I mentioned, is based on the property relations, ownership of wealth and ownership of assets, as well as the position in the social division of labor, the hierarchical structure of social division of labor. Now, there's some changes in the class structure, which is evident in the previous diagram. Let me just summarize that for you. There is an increase in the share of the managerial and professional classes. Now, to narrow this schema down, like to compress it, we can use a broad definition of the working class, which kind of is used in popular press and popular jargon, which is to say that, look, it comprises potential workers, workers and skilled workers. Additionally, you can also put in the supervisors, because who's given the occupational title of supervisor in the Census Bureau scheme are really rank and file supervisors. In other words, you will never identify a supervisor in a white collar, say in a computer software firm, right? There was no occupational category called supervisor there. So they're actually more close to the workers that they supervise, like you have the Walmart managers, working with the floor workers, right? And the self-employed people who are not incorporated. So if you adopt this broad definition of the working class, you'll find that that percentage has declined a little bit from about 61% to 58% between these two benchmark years. So the technological and organizational changes that US capitalism has experienced has not really reduced the working class to a numerical minority. They still remain the major social group. Now, the class disparities in economic well-being are very striking, and they're very durable. COVID does not change that. Great Recession does not change that, at least not in any discernible way. So again, what is shown on the vertical axis here is the ratio of the group's average LIMU to the average LIMU of the working class, right? So for the capitalist class, you can see that in 2020, the latest year for which we are showing the estimates here, it's about 9 times as much as that of an average working class household. Now, for the MPE group, which indicates the managerial, professional, and the incorporated self-employed, it's about 1.3 times higher. So now the key factor here is that the growth in labor income for working class has lagged behind that of other classes. So just to give you an indication of this lagging behind, compared to 2007, labor income in 2020 was only about 2% higher for the average working class, right? Now, for the managerial class, the MPE class, and the professional class, it was about 7%. That is the earnings in 2020 compared to 2007. For those in the capitalist class, it was 19%. So it's this outsized growth in earnings which account for part of this, what we are seeing here. The big part, though, especially with the capitalist household, is the income from wealth. So it's the huge or the outsized income from wealth that accounts for this gap. And the main factor behind this is the recovery in financial market subsequent to the Great Recession and its favorable impact on wealth. So, and we'll get to that part here in a little bit later. That is the comparison of the Great Recession and the COVID-19 shock. So as I mentioned in the introduction, we're going to compare the changes in the economic well-being between these two periods. We're utilizing a standard method. Basically, we're going to look at the impacts on base income, consisting primarily of labor income, then income from wealth, net government expenditures, and value of household production.
Ajit, you have about 5 minutes.
Okay, thank you very much. So what's the basic story here? Well, here we have the decomposition for the two periods, for 2007-2010, which is the left-hand side panel, and the 2019-2020 period, which is the right-hand side. So the numbers on the top of each bar indicates the annual % change in average living. So the colored stacks of each bar indicate the contribution made by the component that corresponds to the color. So you can see there are 4 colors here: base income, income from wealth, net government expenditures, and household production. The last one I mentioned does not play much of a role in either of the two periods. what are the big things that are going on here? Well, for the working class, clearly, they took a big hit that onto their base income, labor income, during the Great Recession. That's the blue panel that's showing the negative territory, as well as in the COVID shock. The COVID shock hit was obviously far higher. And what happened was that net government expenditure actually compensated for that. And that's what gives you the 1.1% number for 2010, and then the 3.3% number for 2019 and 2020. So even though the hit to base income for the working class was much higher during the COVID shock, it was more than offset by the net government expenditures. A different dynamic is at play for the upper classes. You can see that in the 2007-2010 period, they took a hit. Their LIMU fell at an annual rate of about 1% per annum, right? And the main factor that was driving that was the decline in the income from wealth. Now look at 2019-2020. What you see there is that they did take a hit on base income, on labor income, but it was much less than what the working class took. But the big factor that contributed was the income from wealth, which really contributed to boosting their LIMU and giving them the 2.5% gain, to which, of course, net government expenditures also contribute. So let's take a look at the boost to upper class income from wealth 2019 to 2020. Policy stabilizing financial markets directly benefited this group of households more than working class. But income from wealth is distributed highly unequally. Gini in 2020 is about 0.85, which is pretty much close to how high the Gini can be, right? So the gains went disproportionately to a very small elite. So what do our estimates show? There are about 32.6 million upper class households in 2020. The top 10% received 63% of this gain in the income from wealth. The capitalist class that make up 8% of the upper class households got 50% of these gains. Okay, now let's take a quick look. Peter, do I have 5 minutes? Just to finish up?
Just to try to make it like 3 minutes if you could.
I'll try my best. Thank you very much. I'm sorry about shooting it a little bit. Okay, so another way to assess the role of net government expenditure, we can rewrite the LIMU equation in the way that's shown in the first bullet point, right? So now what is pre-fisc income there? Well, it's just basically income before government intervention. We can think about it like that. Of course, that's true only in a strictly accounting sense and not in a substantive economics, right? And the net government expenditures, like I described before, it's the difference between what the government spends for you and what it takes back in the form of taxes, right? So households with a positive net government expenditure is the net beneficiary. Households with a negative net government expenditure is a net payer. Now, looking at the changes in the average values of pre-fisc income and net government expenditures in the two periods is a neat way of seeing what was driving the change in the average, right? So comparing the absolute changes in the two variables during the two periods tells us how much of the loss in pre-fisc income was made up by increased net government expenditure. Now, this is clearly true for the working class in both periods. For the upper classes, the change in net government expenditure was not able to offset the loss in pre-fisc income during the Great Recession. We observe exactly the opposite in 2019-2020, where they did not have a loss in pre-fisc income. Again, the story here is the income from wealth, and it was further bolstered by the increase in net government expenditure. Now, what is driving the change in the net government expenditure? Again, comparing the two periods, we're breaking down net government expenditures into transfers, which is the blue color, public consumption, which is the red color, and taxes, right? So again, because of the lack of time, I can't go through all of it, but the big picture that comes out of this is that what is driving the net government expenditures is the tremendous jump in net government expenditures. And there are two things that are going on here in the COVID period compared to the GFC. First, unemployment. There was a dramatic increase in the scope of coverage and the increase in the amount and duration over which you could receive the benefit. The second was the EIP, or the economic impact payments, implemented rapidly as a refundable tax credit. That accounted for the overwhelming portion of the growth in government transfers once we account for the change in unemployment compensation. Finally, the net benefit rate, which is the ratio of average net government expenditures to average pre-fiscal income, expressed as a percentage of pre-fiscal income. The trends between 2007, 2010, and 2019 and 2020 are shown here. And as you can see, for the not working class, that is MPE class, that ratio is negative, meaning what? Well, they're net payers into the system. But the percentage of what they're paying as a portion of their pre-fiscal income has been falling throughout. In other words, they're getting tax cuts. For the working class, it's a different story. They're beneficiaries of net government expenditure. So let me just sum up here quickly. So class disparities in economic well-being are quite large. Like we saw, the capitalist class is like about 9 times as much of economic revenue as the average working class family. Now, how we measure economic well-being matters for impact assessment. Often the impact of COVID-19 relief measures are, which, when you assess the impact, you're looking at just outsized transfer payments. But as we saw, the measures that caused buoyancy in financial markets led to a remarkable increase in the income from wealth of the upper classes. Right? So we need to look at that too. The net tax payments by the upper class have fallen. Net government expenditures for the working class have risen. Right? Both are trends that are operating in the US economy since 2000. So that's really the visible hand of the state in sustaining economic well-being. Thank you very much for your attention. And I apologize, Peter, for running over.
Ajit, thank you very much. We had 3 great presentations. And now I want to invite everyone to throw your questions into the Q&A function. I don't know if I'll be able to get to all of them, but I'll try to get to as many as possible. So fire away. I do have some questions just to start things off. And so first one, I just want to reiterate the question that Marcia Brown asked. She asked Michelle this question. Well, 2, I'm going to combine 2. First of all, it was more of a comment. She said the first time she'd heard someone comment on the Caucasian bias in informal networks, she followed that up with how widespread was the use of informal networks. And Michelle was kind enough to answer this in the Q&A function. You can all check her answers there. But Michelle, I just thought I'd just ask you to say it for everyone here. Talk about the role of informal networks in helping certain people get ahead and others held back.
Yeah, sure. Thank you, Peter, and thank you, Marcia, for that question. So, at least according to research by Harry Holzer, who's pretty well respected, Black Americans tend to rely on more formal routes to employment. And by that, I mean ads, classified ads, job boards, as opposed to social contacts. And this is in comparison to white Americans. And so if that's the case, that is suggesting that in terms of social contacts, actual people in your sphere, it suggests that Black workers tend to have either smaller social networks or weaker social networks than white workers. And so according to, and this is something I said in my answer to Marcia, according to Granovetter, who looked at the role of social contacts and obtaining a job, he estimated about half of jobs are filled in the US through social contacts. So that right there, poses a barrier to some degree, or maybe to a great degree, for Black workers compared to white workers looking for work. How much can Black workers rely on their informal contacts, their social contacts? How strong are their networks, et cetera? So I would say, I guess in answer to your question, Peter, social contacts are pretty important in terms of access to and entree in the American labor market, and not just in terms of getting a job, but also knowing what to ask for, knowing, what is the salary structure that I can expect. If you have stronger networks that can give you information on a job, they can also potentially give you information on, well, my friend works there and they make X amount of dollars. So it's pretty important, the strength of your social network.
Okay, well, thank you. I got a question for Tom. One is from me and then one is from a member of the audience. Tom, you talked about people sleeping more since COVID started, I think by 3 hours a week. By construction, does that mean that every additional hour of sleep counts as a time deficit and therefore makes them look poor? Because if so, that seems like an odd result.
Well, yeah, I mean, it's an hour and a half additional since the pandemic. So total 3 hours between 2005, 2022.
Okay.
But yeah, the change in minimum personal care, additional hours of sleep means that there's less time to do other things. Right.
Okay. Although people are gonna say, hey, look, you're sleeping. That doesn't seem like something you should, doesn't make you poor to be sleeping more. If anything, it's a luxury.
Well, yeah.
Yeah. All right. Anyway.
But we're basing it on what we see. So
yeah. Okay. And then the other question comes from Maroki Sowell. Does the U.S. stand out compared to countries in the global South with regards to the large share of households that are income non-poor but time poor?
yeah. It's a good question. A lot of the countries, in a lot of the countries that we've looked at, the poverty rates are higher, right? So income poverty, whether official or time adjusted, are higher than in the US, right? So the US is about 10%, Mexico, it's about 40, right? So in that sense, a greater share of the time poor are also income poor or consumption poor. So I was just quickly scrambling to find some other graphs similar to the one I showed for the US. For maybe I can find one for Ghana really quick. Yeah, so I think it's a function of the relatively low rate of official poverty and time adjusted poverty in the US, that you see a larger share of individuals that are employed individuals who are not poor but are time poor. So I think that's what's going on there.
And one more question for you, Tom. I understand the concept of income poverty and consumption poverty, but they're not obviously commensurable. So can you explain again how you managed to do I guess, time adjusted poverty, which obviously meant you had to blend the two measures?
Mm-hmm. Yeah, I should mention consumption, the difference between the income lim tip and lim TCP, the consumption poverty versus income poverty measure, depends on how official poverty is measured in the country that we're doing the estimates in. So for countries like Mexico or the US, where income is the measure, the resource measure as to which poverty is assessed, we do an time and income poverty measure. But in countries like Ghana or Tanzania, where it's consumption poverty, so consumption expenditures that are the measure that are compared to a threshold for poverty, that's what we use, right? So
Okay.
Does that
well, but I'm really not asking about income versus consumption. I'm asking about adjusting whichever one it is, income or consumption, for time.
Right.
Because again, they're different. They're not both in the same numbers. They're the same kind of units. How do you blend them?
The intuition is that a household with time deficits at the poverty threshold would have to have an additional amount of income with which they could hire people to do the things that they don't have time to do.
I see. Okay.
And so
that's how you convert it into dollar number.
Yeah, using what we call the replacement cost, which is just a typical pay for domestic servants in the US.
Okay, great. And now I'm going to move on to Ajit. Tom Strand had a question, and I have the same question. How could you please restate your definition of capitalist? My thought about that was, traditionally, the capitalist is the person who owns the means of production. And so, and consequently, is not somebody who earns money from labor. And yet, a lot of the people in this country who have a lot of wealth, doctors, lawyers, and so on, actually do have labor income. And some are employees, not self-employed. Conversely, there are people who are not extremely wealthy and yet have reasonably substantial stock portfolios, which means they do somewhat own the means of production. So what about that?
Are you combining the two questions from Tom Strand also, or is that a different question?
Sorry.
You mentioned that you're combining two questions. So is this the...
Yeah, I'm taking Tom's question and just elaborating on his question.
Okay, fine. I was just wondering if there was another one too following.
No.
Well, no. Okay, fine. Thank you for the clarification. Well, yeah, this is an interesting question, but the challenge is to identify capitalists or group of people who can be identified as capitalists in household income surveys. These are household surveys, right? So how do you identify someone? So what previous research, what some people have done is to look to see if that person is a business owner, right? So this would be like a typical definition for people who own, a person who owns means production. Then you look at, okay, how many employees that this person has. Now, typically this would work in a very earlier stage of capitalism. The modern stage of capitalism, where the ownership is through ownership of equity, right, through shares, this criteria does not work because nobody owns directly, very few people, rather. And those people are there in our definition, either as owners of real estate or people who have, incorporated equity, business equity. Like, for example, you have ownership stake in a business which is very prosperous. That will be captured in our data. So in terms of using the thresholds for wealth thresholds, the criteria that's used is that if you have, it's not dependent on what you actually do. You may be a very wealthy doctor or a lawyer, right? But the question is like, do you have an amount of wealth that would allow you to live off that and very comfortably, right? So that's the criteria that we use. If we don't use that criteria and if we use just the people who own businesses, then we run the risk of missing out the entire frontier class, which I think is a dominant group of capitalist class, which dominates. And this goes back to what Jamie was talking about earlier about, the change in the US capitalism since the 1980s and how the financial sector has come to dominate the US economy. So the definition that we're using is, of course, specific to the context of the US capitalists, and specifically meant to capture the existence of a financial elite. Now, even that we can only do with serious limitations because the survey that we are using, which is the survey of consumer finances conducted by the Federal Reserve, explicitly ignores or leaves out the Forbes 400. So they're not in our definition of the of the wealthy. Now, that's a limitation of data. So I guess it cuts that way too, that we're not capturing the whole the financial elite.
Yeah. All right. I'm going to repeat that people are invited to ask questions. Meanwhile, I have one. I want to step back. The three of you presented research today, and that's great. But I also want to ask you, what's going on today? Sort of the kind of stuff you'd be chatting about in the hallways if we were doing this in person. There was some optimism in your presentations in that you showed enormous gains for lower income people from the pandemic assistance of different kinds. And then, as I think you mentioned, there's been a recession since then. Some of those things have been taken away. But on net, and I want you to talk to each other a little bit here too. Did that experience of progress give you a feeling of optimism and hope for the future or not?
Well, I'll let Michelle go first
Yeah.
in the order that we were presenting. So, Michelle, you want to take that first?
Sure, Ajit. Quite gentlemanly of you, but I actually didn't want to take it first, but I'll go. So I mean, I would say it has given me a sense of optimism. Of course, I'm going to speak from my own particular research, which is looking at the position of women and people of color in the American labor market. And there have been discernible gains for those groups in terms of wages, in terms of one of the things that came out of the pandemic, as tragic as it was for this country and certainly the world, but it did also show us there are different ways to work for those of us who can do that, right? If we are working in service occupations. So it was good for some women or many women in the American labor market. There were gains. What I also think that the period the pandemic showed, which is something that an economist like myself and others, when we talk about how important a robust labor market is for inequality, it really did show that a robust labor market is great for alleviating inequality. And in fact, as I mentioned in my presentation, the recent narrowing of the Black-white unemployment rate gap has actually been, during the years of the pandemic and post-pandemic, when the American labor market boomed. And this is something, labor economists have been saying, and we saw it evidenced, right? That a strong labor market is good for workers who typically are least favored in the American workforce. Yeah.
Great, and we only have a few minutes left, but I'd love to hear what Tom and Ajit have to say about that.
Well, I guess going in order again. I mean, I'm always the wrong person to ask if you feel hopeful, because I've always been kind of a glass half full kind of guy, half empty kind of guy, and I'm always waiting for the other shoe to drop. So all I see are threats, is what I'm saying, right? So political and otherwise. I mean, I think beyond my own terrible pessimistic perspective, I think generally workers have gotten, at least for a time, a taste of, some workers anyway, have gotten a taste of actual power in choices over what they do with their time, right? And so when you hear workers, when you hear employers complaining that nobody wants to work, right? What they're saying is they don't want to work for under the terrible conditions that we're used to providing for them, right? So, and I mean that also goes to the more general stance of economics, is work is disutility, right? The mainstream approach to conceptualizing labor, and I think my standpoint is always humans enjoy productive work. They just don't necessarily enjoy working for somebody else, especially if they're if they're not great, let's say.
Yeah.
I'll try to
Right.
avoid potty.
Ajit, could you just take just a minute here, because we're just about out of time? Quick thought.
Sure. Well, about the pandemic and its, the relief payments and the household, transfer payments that we talked about. One thing that it clearly showed is that, the number of people that we have designated as officially poor is a policy decision. You can actually change that within a year. So that was very clearly shown. Now, is that sustainable? Not, because that's the low incomeness of a person is often a symptom of other issues that the person is facing, whether it's a labor market issue or other issues, right? In terms of the labor gains, I just want to be a little bit cautious, right? Because we start from a very low base of stagnation in real wages for the working class for a very long time, since like the mid-1970s. So small gains that we are seeing, welcome as they are, they're not putting us back in, on the real road to, worker-focused, rather a wage-led kind of prosperous period in American history. And I think for that, serious political and other kind of changes have to take place.
Well, very good. I think I'm going to wrap it here. I want to thank Michelle, Tom, and Ajit for a great panel, and I'm going to hand it back over. So thanks to everyone for listening as well and for your supplying some questions.
Thank you, Peter, for being such a gracious chair.
Yes, yes.
Thank you.
Thank you, Peter. Thank you,
Thank
Michelle and Jit.
Thank you, Michelle. Good to
Thank
see you.
Good to see you, Ajit. Good to see you, Tom.
Bye.
We see you too.
Bye.
Bye.